All right. Okay, today I'm joined by Ben Smith from Hawke Smith Private Wealth. Thanks for joining me, Benny.
Thanks for having me, Michael.
Mate, just a few quick questions that we can get, that viewers can take on board. Mate, given the situation with COVID-19, what's been the general movements or shifts in the financial markets?
Well, there's been a lot of volatility in the markets over the last month. Some big falls initially. There's been some pretty big gains in recent weeks, for the last 3 weeks or so. I guess those gains have been on the back of many developed economies containing COVID-19 to a degree. Well, that's what's been reported. So the markets have rallied a little bit on the back of that, but I think that's starting to turn again the other way as people start to realise that the earnings forecast for many businesses around the world are hard to quantify, but they're probably going to be quite poor earnings over the next 1 to 2 years, possibly more. So I think that realisation is going to be a challenge for financial markets moving forward. Unless the outlook for earnings changes, it's going to be difficult. And the outlook for earnings is hard, as I said, hard to quantify, particularly because we don't know how long the economic disruption is going to be for. And there could be loosening of some of the measures that have been put in place here in Australia and around the world, but those measures could be tightened again depending on if things flare up. So it's very unknown at this time. Certainly some sectors will recover quicker than others. And some sectors, or not sectors, but some businesses will probably fall by the wayside as a result of COVID-19 and the disruption to the businesses. So that's going to be unfortunate for many businesses and their employees. Looking at this June quarter that we're into now, it's probably going to be the weakest or the biggest contraction in GDP in history for Australia, the UK, America, so most of the developed world. But probably the next quarter is going to be more important. So the September quarter, how is that going to look? And that's probably going to shape the direction, or the speed of the recovery. So will it be a V-shaped recovery or will it be a U-shaped recovery? So a lot longer to recover. And again, that's unknown because the way forward is certainly very uncertain. So how will economies move forward with social distancing? How will restrictions be loosened? When will it happen? All these things are unknown. So it's quite a wobbly path that we're on, and that makes it very difficult to predict economically what's going to happen, which in turn affects world stock markets. So it's really unknown.
In respect of, let's talk mums and dads and your normal sort of investors, people that have got, even just superannuation side of things. It is those sort of investments are generally for a longer term, right? So I think, even though markets might be, decreased or copped a hit because of COVID-19, if you're looking at the long run, you're going to assume that over a long period of time, things will bounce back, right?
That's right. So I think it's very important to, for people, like you said, most working people have got super. So have an investment philosophy. So within our business, there's 5 key things that underpin our investment philosophy. So one's diversification. So quite simply, not having all your eggs in one basket. That'll help provide more consistent returns and reduce volatility even in times like this. Okay. Having a disciplined approach. So like you're saying, adopting a long-term strategy rather than chasing returns or avoiding downturns will help, we believe, and it's been proven over time, will help you it'll stop you from eroding your capital by finding a strategy that suits you and sticking to it. So having that discipline to ride out the tough times, understanding that risk and return are related. So, generally the more risk you take on with your investments, the higher the return you'll get over the long term. Okay. Fourth one's using experts. So outsourcing investment decisions to qualified people, okay, who are unemotional, regardless of ups and downs in markets, and who have extensive research capabilities. So they're the experts that you put your trust in to make sound decisions. Okay. And the fifth one is tailoring portfolios to your needs and objectives and your risk profile. So you could be, there's Mr. and Mrs. Conservative shouldn't have a growth portfolio, and they'd certainly be very uncomfortable at the moment if they did. So you need to understand what you like as an investor, what risk profile you should have. So for many super funds, quite to make it simpler to understand, they'll have conservative options, balanced options, and growth options. Okay, so in good times and bad, you probably should find a strategy that works for you. So that's important. And again, matching your objectives. So if your objective is to achieve growth over long term, then you need to have a growth portfolio. If it's something else, then your portfolio might look different. But as you said, if you look over the long term, going back 10 years. So according to Research House Super Ratings, someone with a balanced fund probably has achieved a return of 6 to 7% over the last 10 years. And that takes into account March 2020. So that's a pretty good return, 6.5% over 10 years, even though you're taking into account March, where markets fell over, world markets fell by more than 30%. So staying invested is very important rather than timing investments.
You're sort of saying to those people who are investing in the high aggressive or high risk categories not to even look at the reports right now?
Oh,
I mean, you've got to be aware of it, right? But I mean,
they're aware of it, but depending, most people who are in high growth strategies probably they should be a fair way from retirement.
Mm-hmm. Yep.
So ideally, if you're close to retirement, you're already in a portfolio that doesn't have 100% of its assets in shares.
Mm-hmm.
And for people that do, it's a very uncomfortable situation. They're going to have to ride it out. And even people who are retirees, and we've said to our clients that are retirees, at this time you might have to look at taking less money to keep more money invested. So when the market does recover, your portfolio reaps the benefit of that time. The government's even made moves to reduce the pension minimums that people have to take from their accounts just to try and help them preserve their capital.
What are the figures or the minimums that they're looking at or proposing?
Well, they basically just halve them, so they go up incrementally based on your age. So I think the first one's roughly taking 5% of your account balance.
It's a sliding scale. Yeah.
Sliding scale. They've just halved them.
Mm-hmm.
So
okay.
So you don't have to take as much.
And that's to retain balances in there.
Yeah, just to try and help people retain their capital. So give their capital a chance to recover from the big hit that it's taken the last 6 weeks.
Mm-hmm.
So it's difficult, but some people can't afford to take that reduction. So it's every client's or every person's situations are unique to them. So.
Yeah. Okay. Let's look at super. Now, the government did announce through the stimulus or the corona situation the ability for people to access essentially 10 grand before July and 10 grand after July. What's some things to consider if people are looking down this path in respect of accessing this super?
Well, I guess eligibility is one thing. So you've got to meet one of the following criteria. So you need to be unemployed. You need to be eligible for a few different payments. So if you're eligible for the job seeker payment, then you're eligible for this super withdrawal. If you're eligible for the youth allowance, parenting payment, there's a few other payments that's prescribed Centrelink payments that you may be eligible for that make you eligible for this super withdrawal payment. Or if you're a business or a sole trader and you've had a 20% reduction in your revenue, then you can also apply for this.
Okay.
This super.
Yep.
For your super. So I guess the other things to consider are there's no tax on the withdrawal, okay, which is unusual. You apply for it via MyGov.
is that regardless of whether the super fund is taxed or untaxed?
Yeah, I'm pretty sure it's just tax free.
Okay. Yeah, right. Okay.
So it's, yeah. So, and you can only, before, when you do it, say you do one before June 30, you can't, the maximum is 10,000, but you can't do it in increments. You can't do 5,000 now and 5,000 a week. It's whatever you do is, it's only one-off.
One transaction.
30, and then one transaction, and then the same between June 30 and September 24 is the next 10,000 you can take in that time frame. And again, it's one transaction. So
what about diving deeper? And this is a conversation between the individual and their financial advisor, in respect of where the actual money is being withdrawn. What investments within the fund it's being withdrawn from?
Yeah, so ideally, if you do have cash within your super fund, you'd take it from cash, leaving shares and property and bonds alone, so they can their assets can appreciate when there is a recovery. Most people probably don't have that luxury. They're probably just invested in a default fund, which won't probably have a lot of cash in it.
Mm-hmm.
But if you do have cash, nominate to receive it from cash. I guess the thing to think about is just the impact that it will have on your super by doing it. So, for example, a 47-year-old in a balanced fund earning 6.5% is 20 years from, say, retirement at 67, which is the pension age at the moment. So by taking that $20,000 out, that'll reduce her retirement nest egg by about $70,000. So it's a big hit. You think, I'm only taking 20,000 out, but 20 years later, that'll be 70,000 less that she'll have.
Yeah.
And if you take it to a whole nother level, and you've got a 27-year-old male, for example, and he's invested via a growth fund, so a more aggressive fund that's, say, returning about 8% per annum, his super will be less. It'll go basically be less 400,000, 430,000 after the 40 years. So from age 27 to 67, by taking that 20,000 out and not getting that 8.5% growth every year on that 20,000, that'll impact his super by more than $400,000 when he retires.
Yeah. I mean, I've had quite a few people sort of ask me the question about accessing the super, and my sort of, without giving him any specific advice in relation to it, it's pretty much my general thoughts are to try to exhaust the external areas of getting money through Centrelink and the job seeker and job keeper side of it before even sort of looking at the super component.
Yeah, that's right. I'd say the same thing, exactly that. If you have to, you have to. And if you do have to, hopefully, sooner rather than later, you're back at work, and you can try and put that money back in. So maybe view it as a temporary loan, and try and put the money back in via personal contributions or salary sacrifice contributions back into super. I know that's easier said than done for many people, but that's just something to keep in the back of your mind. If you can do that, then you can recoup that what you've withdrawn, so you do maximise your retirement nest egg.
Yeah, I mean, look, even if you let's say you're assuming you're maxing out the $20,000. Once everything's back to normality and you're back to normal salary, I mean, in effect, $100 a week over 4 years, and you're going to pretty much put back the money that you took out. Yeah,
that's right. Yeah, so look at it that way, rather than going, oh, Jesus, 20,000 is a big number.
Yeah.
But like you're saying, if you plan it out over a few years, then it seems much more doable.
Yeah, so there are ways of strategizing and making it work, so you're not really copping too big of a hit from your super fund end as well.
Yeah, that's right.
Yeah. Now, through these sort of times, I suppose it's not only these times, but other times, there are types of insurances, income protection products, and different things that are available to cover you for instances like this. What sort of things can people look at or speak to a financial advisor about in respect of the insurances available should they become sick or ill, or natural disasters or anything sort of like this happens?
Yeah, I think, like you say, income protection is very topical at the moment. So it's difficult to plan for unforeseen events But with income protection, you can plan for unforeseen illness and accident, in that you can replace up to 75% of your income if you can't work due to illness or accident, if you have income protection. So at the moment, people already, or people are going to find out very soon, that having no income coming in is a very frightening situation. So there will be there is obviously some government stimulus that most people will be able to access, some people won't. But at the moment, that stimulus is only projected to go for 6 months. So after that 6 months, then people might have any income at all. So it's going to be a very sobering time for many people, unfortunately. And we always say to our clients, if you had the opportunity to protect your income in an unforeseen event such as illness or accident, would you like to do it? And most people want to do it, because if you don't have your income, pretty much everything's going to fall apart. So whether you've got a documented financial plan or a financial plan in your head, it all revolves around income.
Yep.
And
especially this day and age, a lot of people, debt is a natural part of life. Home loans are a natural part of life, financial commitment. So if your income stops, repayments have to stop, right?
That's right. So even if you don't have a mortgage, most people, you're probably paying rent. Whether it's a mortgage or rent, that's normally a significant chunk of most people's income goes to those two things. So yeah, if you don't have your income, it's we're probably going to see this in the coming months. It's quite difficult to keep that roof over your head.
Yeah. Now with the income protection side of it, you can elect to have it paid either outside of super or actually within super. Is that right?
Yeah, you can have the policy owned by your super fund or as a standalone policy. So
and it is tax deductible outside of the fund as well to yourself personally.
Yeah, so inside super, if your cash flow is a bit tight, and for many people at this time it probably will be, super might be the better option. Long term, it's better to have it outside super. You get the tax deduction personally, as you said, so net cost is less, and it also isn't a drain on your super fund, which is ideally meant to be for your retirement. But yeah, you do have the flexibility to use inside super or outside super.
Yep. All right, mate. Just wrapping up. If anyone who doesn't have a financial advisor, what's your piece of advice for someone who doesn't have anyone to speak to? They can reach out to you, or they can reach out to what do you recommend?
They can reach out to us. They can get on the FPA website and have a look through there and see who's an FPA member in their local area. I guess talk to friends and family and see if they're using an advisor. That's normally a good start. And then just go and talk to a few different advisors and get a feel for who they are and what they do, and if they're a good fit for you and if they can help you out. And go from there.
Yep. Okay. And not make decisions based on emotion.
It's very
hard at the moment, isn't it?
Yeah, it is. It's a tough time for many people. So fingers crossed that there's better times ahead sooner rather than later.
Yeah. All right. Well, guys, if anyone needs any financial advice, help, or needs a financial advisor, give Benny a look up at Hawke Smith Private Wealth. I'll drop the website and the link and all the details in the post that I do for this video, Benny. Mate, thanks for your time. Appreciate it, and keep well during these times, mate.
Thanks, Michael. Talk soon, mate.
Okay, mate. Catch ya.
Mate, bye.